Gold enduring a rocky week. Investors zeroing in on this prospect of multiple rate hikes this year. Joining us now from the CME, Bill Baruch, Chief Market Strategist at II Trader, for today's Futures in Focus. Bill, thanks for joining us. Whoa, the move down in gold futures has been multi-day in length. Bill, where are we as we wait for the Fed's big move next week?
Gold finds itself right at the psychological 1,200 level. The jobs number this morning wasn't amazing, but it was good. It was solid. It was enough to assure or nearly assure a Fed hike next week. A lot of this is already priced in, and that's why gold has been down for 6 straight sessions. It bounced off a little bit of support this morning and is actually in the green right now. So eyeing the Fed hike next week, you want to look closer to 1180. Gold could see a little bit of a knee-jerk pressure after a Fed hike. I think there's going to be a lot of support at 1180, and then we've had really good economic growth so far this first quarter, but I still doubt that at some point here in the next 60 to 90 days we're going to see a little bit of a slump, and that's where gold's going to come in, and that could really align as well with the French election and a little bit of uncertainty out there in Europe. So you want to look for gold at 1180, and that be very supportive to the market. This 1200 level though is very attractive.
But let's talk about oil. What a week it's been, especially Wednesday. Biggest decline in crude futures in over a year. We've broken out of that narrow trading range, that narrowest range going back to 2003. Now we've broken through the underside. What's next?
Well, we at II Trader felt pretty solo being really the only bears out there. Everybody is so bullish. The commitment of traders is record longs. Yeah, everybody's talking about that. But a break below $51 was a key support level, and these longs are now liquidating. There's massive open interest, about 30,000 contracts in the $50 put strike that expires next week. So because that expiration is still going, about a week away, that could help keep the selling in check. But listen, we've failed to regain $50 twice now in the last 24 hours, and I think the sellers are in clear control. We're eyeing $45. There's a trend line up there. It's riding up there around 46, and I think that we can achieve it. It may not be until after the April contract options expiration, but this market, I think there's a lot of room to go lower, and in the long term, we're just starting to see production start to come back on in the U.S. Production lags the rigs coming back online from about 6 to 9 months, and we are about 6 months in from the rigs bottoming last fall.
But if OPEC doesn't come out and say, in May we're going to extend these production cuts, what happens then?
Well, you know what? If they come out right now and start building the fact that building a belief that they will cut again in the second half of the year, and they don't follow through with that, that could be catastrophic for the market, and we could see oil get down to $30. They can't build that expectation and then not come through, because this oil cut that they have in the first half really hasn't worked to the degree that they hope they can as shale has come back online. So we could see U.S. production get above 9.5 million barrels per day through the summer. And if this shale, I really want to emphasize, this is just getting started, and I think we're going to see more production come back online through the summer and through the fall. And OPEC's going to find themselves in a sticky situation. We could really just start to find that they're going to ramp up their production to compete with the U.S. shale. I would not be surprised to see oil at $40 by the end of the year, if not much sooner.
Oil at $40 by the end of the year. Big call there, Bill. Great to see.